Ever feel like the financial world operates on pure sorcery? Like there's some secret code everyone else seems to know but you.
Mm-hmm.
Well, today's deep dive might just give you a peek behind that curtain.
Yeah, we'll do it.
We're diving into George Soros's The Alchemy of Finance.
Right.
A book famous, or infamous, depending who you ask, for shaking up the way we think about markets.
Yeah, it's a book that definitely makes you think differently about things.
It does. So for our listeners who maybe haven't had a chance to crack open this book yet, what would you say are some of the big kind of headline ideas that Soros lays out?
Well, Soros, he really doesn't hold back. You know, he kind of challenges the very foundations of like traditional economics.
Okay, so right from the get-go, he's like turning the tables on us.
Yeah, he's overturning the apple cart. See, most economic models, they're built on this idea of an efficient market.
Right.
You know, supply and demand in like perfect harmony.
Everything's balanced, yeah.
But Soros, drawing from his own experience, right, as a legendary investor.
This isn't just theory for him?
No, not at all. He's lived it. He argues that real-life markets are anything but perfectly efficient.
Okay, so where does it all go wrong?
Yeah.
What's he seeing that these models miss?
It's this concept he calls reflexivity, this idea that financial markets, they don't just reflect reality, they actively shape it.
Oh, interesting. So it's a two-way street. It's not just the market responding to what's happening in the world.
Exactly. It creates this feedback loop where investors' biases, and those biases can be anything from, you know, fear and greed to just plain old herd mentality.
We've all been there.
Oh, absolutely. They're baked into the system. Think about it. When enough people believe a certain stock is going up, even without solid evidence,
Right.
that belief itself can fuel a buying frenzy, driving the price even higher.
It becomes a self-fulfilling prophecy.
Precisely.
And this is where I think this idea of alchemy comes into play. Because it's like the market is rewriting its own rule book as it goes along.
Exactly. Soros uses the example of like rising prices attracting more buyers. So, you know, even if the fundamentals don't justify it.
Right. It's not like the company is suddenly twice as good.
No. This creates those boom and bust cycles that we've unfortunately become all too familiar with.
And it's interesting because Soros, he should know, right? The man's a financial wizard himself.
Oh, absolutely. He's not just theorizing from, you know, some ivory tower.
Right.
He's drawing from like decades of experience running his own hedge fund, navigating those same booms and busts. He even compares that experience to his training in survival.
Wow.
Which, when you think about it, kind of gives you a sense of how high the stakes can be in these markets.
Yeah, I mean, you don't usually associate survival with Wall Street, but
No, you don't.
maybe we should. And, you know, the title of his book, The Alchemy of Finance, I think is really intriguing,
Yeah.
you know, because it suggests that there's this mystical element to all this. Like, we can try to rationalize it, but there's this hidden force that transforms the ordinary into the extraordinary.
There's a bit of magic to it, isn't there? I mean, in a way, that's what makes it so captivating, is like he's saying markets have this power, right, to take these raw materials,
Yeah.
you know, like information, expectations, even our emotions, and turn them into something completely different, something unpredictable. Just like those alchemists trying to turn lead into gold.
Right.
Financial markets can transform like seemingly worthless assets into, you know, fortunes.
Or vice versa.
Exactly. And I think nowhere is this alchemy more evident than in the stock market.
Okay, so let's talk about that. How does this concept of reflexivity actually play out in the stock market? What does that look like in practice?
Well, Soros argues that stock markets, they're inherently prone to these distortions. Because see, those investors, those perceptions, those biases, they're constantly shaping the prices of those stocks.
So it's not just about how well the company's actually doing, right?
Yep.
It's about what investors believe about the company.
Exactly.
Which more often than not, those are two very different things.
Often miles apart. Let's say there's like this hot new tech company, everyone's raving about it.
The next big thing.
Right. But even if their actual earnings are like modest.
Still figuring things out.
Exactly.
Yeah.
But the sheer optimism surrounding their potential.
The hype is real.
And that can lead to like a massive surge in stock price.
Okay.
And here's the thing, that surge then influences the company itself.
Oh, interesting. How so?
Well, suddenly they've got all this like inflated valuation, gives them access to more capital. They could make bolder moves, maybe even acquisitions, just because their stock is perceived as being so valuable.
It's like a self-fulfilling prophecy, but on a company level.
Exactly. So you've got this fascinating interplay between like perception and reality.
Okay, that makes sense. But can you give me a concrete example, like a real world company where we've seen this play out?
Oh, absolutely.
Yeah.
Take Tesla, for instance.
Okay, yeah.
The electric car company. I mean, their stock price, it's skyrocketed in recent years.
For sure.
Driven in part by Elon Musk's, ambitious vision, right?
Right.
And this public perception of Tesla as like the future of transportation.
Yeah.
Now, whether or not Tesla's actual production and profitability justify that high valuation,
That's the million-dollar question.
it is debatable.
Yeah.
But the point is that market sentiment, that belief in Tesla's future, it's had a very real impact on the company.
Right. So it's not just about the numbers on a spreadsheet.
No, it's about the story that's being told, the expectations, the belief.
And that story, that belief, it can be a powerful force.
Oh, absolutely.
Yeah.
And this is where Soros' concept of that boom-bust cycle becomes absolutely crucial to understand. Because, see, for a while, investors, they can ride that wave of optimism, that disconnect between perception and reality.
Right, but what goes up?
Must come down, exactly. Yeah. And that's where things can get a little hairy, because eventually, reality has to set in.
So how do we, even if we're not, financial wizards like Soros, how do we start to recognize those moments when that gap between perception and reality is getting a little too wide?
That's the million-dollar question, isn't it? And, I think one of the big takeaways from Soros is that we have to be willing to kind of challenge our assumptions.
Okay, so don't just follow the herd.
Exactly. Because most people, they get caught up in the excitement, the fear of missing out.
Right.
And they end up buying high and selling low, which is, the opposite of what you want to do.
Right.
So I think it's about taking a step back, looking at the fundamentals and asking ourselves, okay, is this stock, is this asset, is this entire market, is it really worth what people are paying for it?
Right. So due diligence, even when everyone around you seems to have diamond fever.
Exactly. Because remember, the market, it's driven by emotions as much as it is by logic.
Okay, that's really interesting stuff.
Yeah.
So we've seen how this concept of reflexivity, this idea that our beliefs can actually shape reality, plays out in the stock market. But Soros argues that it's even more powerful, even more volatile in the world of currencies.
Oh, absolutely.
Why is that? What is it about currencies that makes them so susceptible to these kinds of self-fulfilling prophecies?
It all boils down to the nature of currency itself. See, in the stock market, you at least have a company, right? With tangible assets, They're producing something, there's a service, there's at least some basis for valuation, even if it's subjective.
Right.
But in the currency market,
it's just money for money.
Exactly. There's no underlying asset. You're basically trading one abstract idea for another. So the value of a currency, it becomes almost entirely driven by expectations, by speculation about its future worth.
And as we've seen, those expectations can be easily swayed.
Oh, absolutely. And they're constantly in flux. It's like trying to nail jelly to a wall.
So it's even more important to understand those forces of reflexivity when you're dealing with currencies, because the swings can be even more dramatic.
Absolutely.
And it's not just big banks and hedge funds making these bets, right? I mean, I'm participating in the currency market when I travel abroad.
You are. Every time you exchange those dollars for euros, you're part of this massive global system.
Wow. And all of those individual transactions, they add up.
They do, and that's what makes the currency market so vast and so difficult to predict. It's like this constant flow of speculation, right? Combined with the fact that there's no real tangible asset anchoring the value, makes currencies inherently volatile.
So it's not for the faint of heart. You really have to know what you're doing, or at least have a strong stomach to play in that arena. Now, I want to go back to something you said earlier about speculation.
Okay.
Because, on the one hand, we tend to think of speculation as a good thing, right? Like, it helps stabilize markets, it keeps prices in check.
Right, the invisible hand, right, keeping everything in balance.
Exactly. But Soros, he challenges that view, doesn't he?
He does.
So he's saying speculation can actually make things worse.
Especially with currencies. He argues it can really throw those markets into chaos. Remember, we were talking to those two lines on the graph earlier.
The one representing the actual value, and then the one showing what the market thinks it's worth.
Exactly. Well, Soros says in currency markets, those lines are constantly in motion.
Oh, so it's even harder to tell what's real and what's hype.
Exactly. It's like trying to predict the weather, a month from now. There's just too many factors influencing those exchange rates. Economic data, political events, heck, even rumors can send those currencies soaring or plummeting.
So how can anyone make sense of it?
Well, that's the thing. It's incredibly difficult, even for the experts. And here's a fun fact for you. Even Soros himself, with all his experience, all his insights into how markets work, he's admitted that he hasn't always won big in the currency market. He knows firsthand how unpredictable it can be.
So you're telling me even the guy who wrote the book on financial alchemy can get burned playing with currencies?
Precisely. It just goes to show that there's always an element of chance, an element of the unknown in these markets.
So we've talked about reflexivity, how our beliefs about the market can actually shape reality, and how that plays out in stocks and currencies. But Soros doesn't stop there, does he? He goes even deeper into what he calls the credit cycle. What's that all about?
Right, so this is where things get really interesting, because Soros argues that just like we see these speculative bubbles in the stock market, driven by investor sentiment, the world of credit also goes through its own booms and busts. Think of it like this giant bellows, expanding and contracting, fueling the fires of the economy.
Okay, I like that analogy. So walk me through it. What's happening when the bellows expands?
So when credit is flowing freely, when interest rates are low, businesses are eager to borrow money, right?
Makes sense. They want to invest, expand, hire more people.
Exactly. And all that economic activity, it creates this positive feedback loop. People feel confident, they spend more, businesses see profits rise, and they're willing to borrow even more. So the bellows, it just keeps expanding, pumping more and more credit into the system.
So where does the bust come in?
Well, at the heart of this whole cycle is something called collateral.
Okay. Remind me what collateral is again.
It's basically an asset that you pledge as security for a loan.
So, like, if you're buying a house, the house itself is the collateral on the mortgage.
Exactly. And the same goes for other types of loans. Businesses might put up equipment, inventory, even their accounts receivable as collateral. Now, here's the catch. The value of that collateral, it's not always as stable as we think.
Okay, I'm starting to see where this is going. So, the more prices rise, whether it's for houses, stocks, or whatever assets are being used as collateral, the more people feel like they can borrow because the lenders see that collateral as being worth more and more.
Exactly. And as long as those asset prices keep going up, everything seems fine. But what happens when the music stops?
When the bubble bursts.
And precisely. Suddenly, that collateral that seemed so valuable just yesterday, it's not worth nearly as much.
Which can trigger a wave of defaults and a credit crunch that can send the whole economy into a tailspin.
Exactly. And this is where Soros' insights from the 1980s become eerily relevant. Because he was looking at the rise of things like mortgage-backed securities, which were essentially bundles of mortgages that were sliced and diced and sold off to investors.
And those were a big part of what triggered the 2008 financial crisis, right?
Exactly. And it all boiled down to this dangerous assumption that housing prices would just keep going up forever. But as we saw, that wasn't the case. The bubble burst, people couldn't pay their mortgages, the value of those mortgage-backed securities plummeted, and the whole financial system nearly collapsed.
So the credit cycle, it's like this giant game of musical chairs with trillions of dollars at stake. And as we've seen, when the music stops, it can get pretty ugly. But Soros, he adds yet another layer to this, doesn't he? This idea of a regulatory cycle. What's that all about?
Right. So Soros argues that regulators, as well-intentioned as they may be, they're not immune to these cycles either. They're like the referees in this giant financial game, trying to keep things fair and prevent players from breaking the rules. But they're also influenced by what's happened in the past,
They're trying to prevent the last crisis, not necessarily the next one.
Exactly. And the problem is, markets are always evolving, finding new ways to push the boundaries. So by the time regulators catch up and implement new rules, the game has already changed.
And we're right back to that game of catch-up you were talking about earlier?
Precisely. And this is what makes Soros' observations from the 1980s so relevant to our current situation. He wrote about how authorities often intervene to prevent a market crash, which can seem like a good thing in the short term, right? But in doing so, they might actually be delaying a necessary correction, making the eventual fallout even worse.
Like we're constantly kicking the can down the road.
Exactly. And Soros, he actually conducted a real-time experiment to test his theories about these cycles. He found that the more authorities intervene, the more they tried to manage these booms and busts, the more stuck the whole system became.
Stuck in a state of perpetual crisis.
In a way, yes. And he even compared it to, like, repeatedly going to the brink of an abyss and then recoiling at the last minute. You get a brief sense of relief, but you're still standing at the edge.
It's not exactly a recipe for stability. So if even a financial mastermind like Soros couldn't perfectly predict or control these market swings, what hope is there for the rest of us? What are we supposed to take away from all of this?
Well, I think the key takeaway is humility. We have to acknowledge the limits of our knowledge, the fact that we can't control everything no matter how sophisticated our models or how much data we accumulate. The markets, they'll always find a way to surprise us.
So we should be skeptical of anyone who claims to have all the answers, even if they have a Nobel Prize in economics or a track record like George Soros.
Exactly, because at the end of the day, it's not about trying to outsmart the market. It's about understanding the forces at play, managing our own risk, and, maybe most importantly, learning to live with a certain degree of uncertainty.
That's a great point to end on. And for our listeners, if you're interested in diving deeper into George Soros' fascinating and sometimes mind-bending ideas, I highly recommend checking out his book, The Alchemy of Finance. It's a challenging read, but trust us, it's worth it. You'll come away with a whole new perspective on how markets really work, and maybe even a healthy dose of skepticism the next time someone claims to have all the answers. Thanks for tuning in to this deep dive into the world of finance. We'll see you next time.